Welcome back to the Make It Count podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
I'm Tyler Warner, small business owner with a lot of accounting questions. And I feel like every week that's getting truer and truer.
Well,
It's
that's
just
what we have
more
here.
and more questions.
But it's good because you make me think about it from a client perspective. Like, wait, explain that?
Yeah.
Yeah.
All right. So here's the questions for today. It's going to be focused on probably P&L organization, budget organization, chart of accounts, that kind of stuff. And maybe you can help us understand the difference, when to use which for why, and
When to use which for why?
yeah, what, the who, what, and why of chart of accounts.
Okay, let's do it.
Yeah, so let's start with some of the war stories you've seen. You've seen a lot of books.
Yeah.
What's just
Yeah, I want to give people definitions, right?
Okay, that'd be helpful.
So let's start ground floor. Any accounting software has a chart.
You just left Office Depot with your box of QuickBooks.
The green box.
That's right. All right.
Please don't.
Step 2, you insert the disc,
Oh,
and then
God.
what happens next?
Jeez, I'm having like PTSD. So any accounting software is going to have a chart of accounts, and a chart of accounts is all it is used. These are the line items you see on the financial statements. So, for instance, you might have an account in your chart of accounts called, Chase Checking. That's obviously your checking account. You might have office supplies and different things, but these are how you're tagging or accounting for things that go in the bank account and on your credit cards and all that kind of stuff.
All right. Now let me ask you the who.
Yeah.
Who decides to create these? Because remember,
Yeah, one episode. I know what you're gonna say. You thought it was handed down by the government.
I thought maybe they had some issues or guidelines on what.
No, this is a good and a bad. So anybody, when you create a business and you go and you get your accounting software, you can manipulate it however you want, which is good and bad. The problem, here's what happens with a lot of people, and we'll get to this probably in more detail toward the end of the episode. What you don't want your accounts in your chart of accounts to be is super granular descriptive. What do I mean by that?
Yeah, so I say because that sounds a little counter to what we're always talking about.
Think about
of data.
Let's just say you have supplies. I've seen people that say they have an account, not a vendor, an account called Amazon, an account called Walmart, an account called Office Depot. What you should have, those should all be vendors, and when you spend to any of those businesses, you should code the expense to supplies. Then if you wanted to see the detail of supplies by vendor, you would open up the supplies account. Like you click on the P&L and say, okay, I can see for the last 3 months I've spent $10,000 on supplies. Let me click in that, expand it, and see who are the vendors responsible for that $10,000 balance. Does that make sense? So you don't want your P&L, because what happens is, I had a buddy of mine, I told you this earlier, he had like a 10-page P&L, profit and loss statement, because he had salaries dash, Susan, salaries dash Tom. It's like, no, it's just salaries. You can drill down in the detail to find out how much you pay Tom and Susan. It doesn't need to be on the face of the reports. The reports, they're not summaries, but they're also not granular based on vendors and very precise data points. Precise data points are found when you drill down in the account.
Okay.
Like, for instance, in that supplies example, you could open up the $10,000 that you spent for the last 3 months and say, okay, I can see every transaction, date, amount, vendor that totals up to the 10,000.
Yeah.
That's where you're going to go and get the detail. Now, you might go a little more granular based on your business, but not as much as I see a lot of people doing.
All right. So how do you just determine what's best? Like, is there some formula guidelines in terms of every business is a little different.
Yeah, I think the stock chart of accounts that come in Xero and QuickBooks Online are good enough. And then, like you said, to your point, every business is different. Then you optimize a little bit. You customize. You add a few, right? Like if you have a business that has, let's just say, cost of goods sold, you might want a couple different accounts to delineate. Maybe like if you're a landscaper, you might have a cost of goods sold account that is direct labor, and you also might have one that's materials. right? You wouldn't want it just in cost of goods sold. You'd
Right.
want to know, like, okay, of the direct cost of doing these jobs, how much did I pay for labor and how much did I pay for materials?
Right.
And then you could get, if you wanted, maybe go a little further. If you didn't have tracking categories or divisions, and we're going to talk about this, maybe you had an account called like cost of goods sold, materials, commercial, or residential. But even as I say that, I'm like, that probably should be a tracking category or a
Yeah.
division.
So here's what I'm thinking. Why that happens is because one, tracking category. I've used Zero for a couple of years now. Tracking category, I know nothing about them.
Okay.
So walk us through tracking categories. And my point is, like, the reason people probably get these like bloated P&Ls is because that's where we know to go.
Of course.
So every month or every so often you generate the P&L and you're like, oh, this doesn't show me what I really want to know. And so then you think, I know I could be getting all this data. I want to know like what I'm
Right.
spending and blah, blah, blah.
Right.
And so next thing you know, you do end up with 30 categories underneath supplies, because I've even done, like, I'm thinking of my own where I'm like, I've got recurring subscriptions and then like, non-recurring. So I can kind of see, because when I generate, I'm like, I want to know, oh, am I spending, X amount every month versus what are kind of one-offs,
Right.
No,
that's good. I think, look, there's no exact science to this. But what I would say is when you start using when you back up, like start using accounts to delineate things that would be more or less better described with a division or a dimension, and I'll explain what I mean by that, then you need to stop. Here's a perfect example. Let's just say you owned 3 Subway franchises. One on Main Street, one on
in the airport.
10th, and one at the airport. Okay. Every time you bought supplies, you wouldn't want to have an account called supplies-Main Street, supplies-10th Street, supplies-airport. You just want supplies. Then you create a tracking category for the divisions you have. Though in that example, you have 3 divisions essentially. And you would say every time you spend, let's just say you're spending for Main Street. Well, on the transaction, you would code it to supplies, but in Zero, it would also have another field. That's what it is, it's a field. Mm-hmm. And you would say, put that to the Main Street tracking category. Now, what does that do? Well, that first allows you to just have a supplies account. That when you're running a P&L over the whole company, if you just want to know all my divisions combined, how I'm doing, well, now you don't have to aggregate 3 accounts that say supplies dash such and such. That's the first thing. Second thing is now I can run a P&L. I just want to know what did I make and spend at the Main Street location. I could run a P&L that's filtered by the tracking category. So now I can say, oh, I know and again, garbage in, garbage out. If you don't tag all the transactions, you'll be left with a lot of things to unclassified. That once you start using tracking categories, Zero then makes an unclassified one. Mm-hmm. So because the sum of all the tracking categories has to equal the total. So it's basically the catch-all. But my point is, as long as you're tagging all of your transactions to the right tracking category, and then maybe intentionally leaving some for unclassified, you might say unclassified, i.e. overhead. Like a good example would be maybe you got a general manager over all 3 stores. And you can't really quite identify how much.
Yeah.
You would just maybe have that in an unclassified or an overhead tracking category. Mm-hmm. You pay a CPA for all 3 locations. Well, you can't break that out. Well, that's a good data point to have.
Yeah.
Overhead. So it just starts to give you